Continue to question example. The following information was provided by Kapoor Manufacturing Company on 30 April 2016. Revenue 661,500. Inventory at 1 May 2015, which is at the beginning of the accounting period. We have raw material, work in progress, finished goods, yeah, and then purchase of raw material, purchase of finished goods, carriage on raw material purchases, factory wages, indirect and direct and indirect. Yeah, direct means that this belongs, this will be entered as the direct labor. Meanwhile, for the indirect, it will be under factory overheads. Yeah. Next, we have royalties. Royalties is a direct expense that is not categorized as direct material as well as direct labor. Yeah. So royalties here is the direct expense. And then we have insurance, rent and rates, factory general expenses, factory machinery at cost, office equipment at cost, and loose tools at valuation. Okay, pay attention on this word. We have insurance and rent and rates. Yeah, these two we did not given with information whether it is for factory or for office equipment. Yeah, it means you will find these that information whether um, the percentage for factory and office equipment by how much will be in the additional information. Yeah, so when you see any expenses that is not allocated, so the information will definitely belongs or definitely will be in the additional information. Not like this one, factory general expense. It is literally said factory, so 100% all goes to factory overheads. Yeah. Factory machinery at cost. This is non-current assets. We're not going to calculate that as factory overheads because this is not an expense. Yeah, this is an asset. When you see at cost like this, this is non-current asset. Yeah. Why do you need this information? Usually you will be given with depreciation information, and that depreciation is the one that you must calculate and enter it in the factory overheads or income statement. Yeah. So this factory machinery at cost will be needed for calculating depreciation on factory machinery that will be entered as factory overheads. Yeah. Meanwhile, for office equipment at cost, since this is not for factory, so you still need to calculate depreciation on office equipment, but it will be entered in the income statement because it is belonging to the office, yeah, not in the factory. Next is loose tools. All loose tools are belongs in the factory. Yeah, loose tools is like a screwdriver, um, pliers, yeah, saw and everything. Yeah, it relates to fixing or repairing the factory machinery. Yeah, so this is also belongs in the factory overheads, and you should calculate the depreciation on loose tools using revaluation method, and then will be entered in the factory overhead as well. Yeah, because loose tools belongs in the factory. Yeah. Okay. Now, since you have all this information, let's go to the additional information. We have inventory at the end of accounting period. closing inventory. And then we have outstanding insurance. Outstanding insurance means accrued at the end, yeah? Accrued at. This was for closing inventory. And then 2/3 of the insurance is allocated for the factory and 1/3 is for the office. Now we pay attention on this one, yeah? 2/3 will be factory, 1/3 will be for office. Okay, so the one that must be entered in the factory overheads on the insurance is 2/3 only. Okay, but before you calculate this 2/3, there is an outstanding of insurance. So what should you do? So from here, accrued at the end will be added with 300, right? Because accrued at the end is added. After that, you will have 3,000. Now this 3,000 will be separated between entering in the factory overheads, which is 2/3 of the total, and then we put that under IS for the expenses, 1/3 only. Yeah. So once again, factory 2/3, IS 1/3. Yeah. But before you allocate the insurance expense, you need to adjust it with accrued or prepaid. Yeah. Do not allocate it first and then adjust it with accrued or prepaid. Yeah. Please adjust it first and then allocate it. Yeah. Next, number 4, half of rent and rates are allocated for factory. Half, yeah? So half. Okay? Half means that for rent and rates, there is no accrued or prepaid, so you don't need to adjust it. Then you just have to allocate it for factory overheads 1/2 or half. Meanwhile, for IS is also half. Okay. Next, factory machinery and office equipment is to be depreciated 10% on cost. 10% on cost indicates that it is a straight line method. Okay. Straight line method. Okay, so what should you do? You just have to calculate it with the cost. So 10% times the cost. Yeah. So if I calculate it here, how much is it? It is going to be 10% times 95,000. Meanwhile, for equipment is 10% times with 10,000. Okay, now you have depreciation. Next, for loose tools, we have to calculate the depreciation also for loose tools, but using the revaluation method. If you don't remember how to calculate um, using the revaluation method, I suggest you to look again on chapter 12 of depreciation. Yeah. So to calculate depreciation, we have to um, adding the opening balance, which is the opening balance is 850, and then you must add with any purchasing during the year. It said here there's no addition. No addition means no purchasing, yeah? No addition as well as disposal. Okay, so no purchasing, no new purchasing. Or disposal. Disposal means you sold it, yeah? No sell, no get the point, yeah? So no new purchasing, no sale as well. So what should you do? You should add this 850 with purchasing. The purchasing is 0 and the disposal is 0, yeah? Plus new purchasing and minus sales of old closed tools, yeah? Since it's 0 and 0, last one is to compare it or deduct it with the closing balance. The closing balance is 800. Okay, so you have 50, and this 50 is a depreciation on loose tools. Okay, once again, this new purchasing goes here, while for sale goes to this time. Yeah? Okay, then let's continue to do manufacturing account. The template is this one, the manufacturing account. Yeah, we start with direct material, inventory, purchase at raw material, purchase return deduct, carriage inwards, and inventory at the end. Yeah, exactly the same like you calculating COS or cost of sales, but this one is using raw material. Yeah, okay. So here it is, the manufacturing account. First, you have raw material. Yeah, under opening raw material under direct material or raw material heading, then you just have to add all the informations given above. Yeah, opening raw material, you will see it in the trial balance over here, 14,900. And then purchases of raw material also in the trial balance. Yeah, I'm not going to back and forth, up and down. Yeah, you already understand. You should already understand. Purchase raw material here, carriage inwards added. There's no purchases returned on raw material, so we skip it. And then minus with closing inventory right here, and then you have direct material check. Yeah, done. And then direct labor. The direct labor here is under this one. Factory wages for direct is direct labor. Yeah, remember, wages of a person who directly touch or directly um, handling the goods will be for direct labor. Okay, for the indirect labor, it will goes to the factory overheads. So continue. We have direct labor. Place it here. Remember to always check on accrued or prepaid. Yeah, if you have accrued on direct labor, you have to add it first. Okay, and then we have direct expenses. We have royalties, so the direct expenses will be here. Again, the analysis is already in here. I already put it here. Yeah, and then you have total of all direct costs. 1, 2, 1, 2, 3. We have 3 direct costs. We have prime cost. This prime cost must be stated. Do not skip it. Okay, you must calculate the prime cost. After prime cost is done, continue to factory overheads. The factory overheads, you put all expenses happens in the factory place. Yeah, so we have factory wages for indirect, checked. We have insurance, but only for factory, based on this calculation, or in this calculation. Yeah, the same. You add first, and then you separate or you allocate 2/3. Yeah, and rates half. Okay, so we have insurance like so, rent and rates done. Factory general expenses, all of it for factory overheads, and then depreciations of factory machinery, check. Depreciation of loose tools, done. Yeah. Do not enter depreciation on office equipment because it belongs in the income statement. Yeah. Okay. The total factory overheads is here, and then prime cost plus with factory overheads, then you have cost of goods manufactured. Yeah. After cost of goods manufactured, then you add opening work in progress minus closing work in progress. Where did you get this? Again, from the question. Yeah. You have opening and you have closing. Done. And then the net is 150. What if the net is negative? Then you put bracket. Yeah, as simple as that. And then after that, you add, and then this one is the total of cost of production. Yeah, that will be transferred in the income statement. Okay, now continue. If Kapur produces 20,000 units of goods, based on the total cost of production that Kapur had from manufacturing account, Kapur can calculate the cost of one single unit of goods and will be used for further decision to set selling price. If cost of one unit goods of Kapur Manufacturing Company is 473,400, if he produces 20,000 units, it means one unit will have a cost of production of $23.67. Means if we want to sell this good, if couple want to sell this good, it has to be added. Yeah, it has to be added with profit margin. Yeah, let's say Kapur cannot sell less than this. Yeah, if he wants profit, he must sell more than this. Yeah, including adding the profit in to the cost of production per unit. Yeah, so that Kapur can get profit. Yeah, so that's the point of this one, having this cost of production to be able to calculate cost per one single unit. Yeah, so that you can set the selling price. Okay, next, income statement. Referring to question of Kapur, income statement of Kapur will look like this. First, we have sales, check, yeah. And then for income statement, we are using finished goods inventory rather than raw material and work in progress, because raw material and work in progress have already been entered in the manufacturing account. Yeah. So we are using the last inventory that we have, which is finished goods. So you have opening over here, and then purchases of finished goods, if any. Yeah, if any. Okay. If there's no purchases of finished goods, then you can just ignore. Okay. And then the one extra is the cost of production. Okay. This cost of production that you calculate from manufacturing account will be entered and added in the cost of sales. Okay. Yeah. So the one that must be there is the opening inventory of finished goods, cost of production, and closing finished goods. This purchases of finished good, if there isn't any, then you just have to ignore it. Yeah, the three of these things usually appear, except that if you are a manufacturing company that just started and this is your first year. If it is your first year, opening inventory will be 0. Yeah, I assume you must already know that because we have discussed it so many times. Yeah. Okay, so after you have cost of sales over here, then revenue minus cost of sales, you have gross profit. After gross profit, you enter all expenses appear in the office, not the factory. Yeah, office. Okay, the insurance we have 1/3, and the rent and rates we have half of 2,900, and also we have depreciation on office equipment. Yeah. Yeah. Okay, so you have all of the expenses for office only, and you put it here. And then next is to calculate net profit by deducting gross profit with office expenses. Okay, then you have net profit. After you have net profit, Continue. Statement of financial position. In the manufacturing business, you're not required to do full statement of financial position. Okay, usually they only ask you to have an extraction of SOFP showing the inventory amount. Okay, because in the manufacturing company, the only difference in the statement of financial position is on the inventory part. Okay, so in a manufacturing company, extract of statement of financial position as at 30 April 2016. Inventory is under current assets. So after current assets, you will list of all your inventory. So you have three inventories like so. You have raw material, you have work in progress, and you have finished goods. And the amount of this is the amount of closing inventory. Where did you get this one? You will get it from the additional information of the question from here. Okay, so that's it. That's all about the manufacturing company. This chapter is finished.